Miriam from The Adaptive Human. Welcome to this latest episode of the Adaptive Human podcast. Today I'm excited. I have Riccardo Romeo here with us. He has over 20 years of investment experience in the private wealth management industry. He's a portfolio manager, chief compliance officer, vice president, and managing director at Summit Investment Management, Inc. He has a unique perspective of the financial services industry, having worked in multiple roles throughout the investment process. So it's really interesting to know that Riccardo not only works as an investment advisor, but he also teaches at the John Molson School of Business here in Montreal. He is also interested in real estate. So a lot of people talk about real estate in terms of investment these days. He's married with 2 children, has an interest in home renovation, enjoys travel, although I don't think any of us are traveling much right now. He's passionate about finance, teaching, and coaching youngsters. He volunteers as an assistant soccer coach for girls' development teams. So if you have any questions for Riccardo when we're done here today, his information will be in the comment section and in the description section everywhere where this podcast will be posted. Riccardo, how are you?
Good. Yourself, Miriam. Thanks for having me.
I'm so happy that you're here. I'm doing great. I'm always excited when I get to talk to people about finances because I think it's something that most of us shy away from, right? It's a dirty word. It's an important word, but it's a dirty word. Yeah. It makes most of us uncomfortable. We start to sweat and we get uncomfortable. So I know that I use some big words there: compliance, investment. What is it that you actually do?
So I'm a portfolio manager, and I guess I should explain what that means because there's a lot of jargon in investments and finance. So really what that means is I help people with their money. And as a portfolio manager, what differentiates me versus other professionals is that I'm a fiduciary. So that means that with all my clients, I have to act with care, with honesty, and always in their best interests. So that means not only coming up with an investment strategy or portfolio that's suitable to their risk tolerance and their objectives, but also something of a lower fee or reasonable fee basis. And when I'm coming up with these investment solutions, it's very important that I act independently. So this is what gives trust to clients. Another difference would be expertise. So as you mentioned, I've been in the investment industry for a long period of time. So only about 3% of investment professionals are portfolio managers like myself that work in independent firms. So there's another difference with respect to investment expertise. Another difference that I can mention with respect to portfolio managers is that we're making decisions, which we call on a discretionary basis. So we're managing money for clients and we're doing it on their behalf. So that means I don't need to get their approval for every transaction or anything that I propose because I have the expertise to do so. We sit down together and we create what is called a written agreement or investment policy statement. So that guides the client with respect to the decisions that I'll be taking with their money. So I'm constructing a portfolio and I'm customizing it according to what their needs and their objectives are, and also what some of their wants are, because every client is different.
Okay, interesting.
Yep.
It's often we hear the words, but we don't know what you actually do. Yeah. And there's something that I've been hearing a lot about. I've talked a lot about lately with people that I know. I guess I've become more aware of it now that I have kids, now that I'm hitting the big 4-0 next year. So I'm a heck of a lot closer to retirement than I was at 20. And so, financial independence. Like, what
Yes.
does that actually mean?
That's a really good question. I think that should be, most of our goals should be to be financially independent. I know that's many of my clients' goals and my own goal personally. Basically, that means that you're going to be able to live with your investments, that you're able to live in a state, an independent state, where you can have all your living expenses paid paid for you, and you can decide to choose to retire at an early age. Usually, that implies you have some sort of passive investments in either stocks or real estate or other investments that incur interest and dividends.
Okay. So it's really interesting because it's funny. I'm a business coach. I focus a lot on business, but I'm a
Yes.
big believer in setting goals long term, right? And a lot of times people tell me, I want to be financially independent. And you might tell me I'm wrong here, but I think there's a difference. You need different amounts depending on what type of lifestyle you want, right?
Exactly.
Like, do you want to take cruises to exotic locations 3 times a year? Are you okay with, spending your summers in your backyard? Like, what type of retirement do you want? And I think that that's also super important to talk about. Before having kids, I would have said like, I'm going to buy a house in Costa Rica and I'm going to spend the rest of my life in Costa Rica when I retire. And now I'm like, but what if they stay here and I have grandkids? And so it changes your plans a little bit.
Yeah, it does. It really is about what kind of lifestyle you want now and as you go older, and especially when you retire, because that's going to drive a lot with respect to what amounts you need to save, what amounts that you're budgeting, because savings really is a factor of budget. So basically determining what your expenses are on a regular basis. Usually we would suggest on a monthly basis versus the number or the amount of income that you're bringing in on a monthly basis. So you want to start off with determining a budget of where you are right now. And then what you want to do is you probably want to tweak it. You want to see where you can make some cuts in terms of expenses. You might want to also entertain other sources of revenue to see if you can maximize your revenue, and at the same time determine what your lifestyle would want to be now and in the future. That's what's going to drive part of your investment plan.
It's really interesting because a few months ago I had a budgeting coach who was part of my podcast, and I've since watched some videos or her feed on social media about how she works with people. And it's amazing to see sometimes where your money is wasted. I have a neighbor, I see him leave here 4 times a day to go buy a coffee at Tim Hortons.
Right.
And I sit there going, wouldn't it be cheaper to have a pot at home?
And the answer would probably be yes. That's a very, very good point. I mean, you can determine additional savings just by making some small lifestyle changes. However, there will be big decisions that need to be done. I've dealt with clients and prospective clients that, have to make harder decisions, i.e., do they have to change living requirements in order to save more, in order to have more for the future. So cut a little bit off now in order to make more, to save more, and to have more for the future. So sometimes there's really hard decisions to be made.
Yeah. So, if you really had to identify some elements of building wealth, what would you say?
I definitely would. I think that the budgeting aspect is a very important one. I think everyone should have a sense of how much they're making and how much they're spending. on a regular basis, monthly and annual basis, and to tweak that in order to reduce costs somehow and try to save more. So determine some sort of savings plan via budgeting. So that's point number one. We can talk, probably don't have time to do that today, but budgeting in itself is a whole conversation and probably a podcast or two in itself. So, there's ways that you can save money, and there's ways where you can, increase your salary even with a side hustle or a side job, or even with your current job. So budgeting, I think, is an important point to start off with. The second area is I would look at either understanding yourself or getting somebody to help you understand the investment basics. And I can go over a few of them if you'd like.
Yeah, of course.
So the first thing that I think all people need to understand is that you need to determine what again, what lifestyle you want to have, and how much money do you need for that lifestyle, how much money do you need to save for it now, and determine these objectives and determine what return is realistic to get these objectives. Now, sometimes there's a mismatch between what a client wants, for retirement versus the amounts of money that they're saving now. So then things have to be changed. You have to save more. Maybe you have to get a better return on your investments. So these are the things that have to be determined. Most financial professionals will sit down with a client, will give them some sort of investment questionnaire, and that questionnaire will test the client's risk tolerance, look at the time horizon, look at their appetite, willingness to accept risk, and how they feel with volatility when markets and things go down, and determine some sort of return objective according to their profile. Now, that profile is very, very important. In finance, we call that the asset allocation. What percentage of their money goes into different asset classes? Because that is the main driver of future returns.
Yeah.
So I think that is important, and usually professionals go through that with clients. So that's why it's very helpful to work with a professional. Yeah, exactly, like myself.
Spoiler alert, if you're listening to this and your professional has not gone through this with you, do it.
Well, that's a really interesting point, because a lot of studies show that people do better when working with a professional. And of course, I'm biased. I mean, that's what I do for a living. I see it myself. Mm-hmm. There are people that want to do things themselves. It does take willingness, it takes education, and it takes time as well. So for some people, that is suitable too. But studies show that working with a professional does increase wealth more over time. And one of the main reasons is avoiding emotional mistakes. So that would be another factor that I think people need to know about. It's just a human thing. We all make emotional decisions, and sometimes they're simple, like selling, let's say you wanted to move and you wanted to move right away, and instead of waiting a couple of months to sell your house, you sell it right away, and you could have capitalized on, I don't know, tens of thousands of dollars more if you waited. So these are the emotional mistakes that people make. In my experience, what I see a lot is when people panic sell, when the financial markets go down, usually the best advice a professional like myself can give somebody is not to panic sell. For instance, last year when the COVID hit the financial markets and the markets were down about 35%, we were making sure that our clients weren't panic selling. So these are what I mean by avoiding emotional mistakes. I think a good understanding of another investment basic is inflation. And I don't think people understand that. This all comes with financial literacy that, as you mentioned, as you briefly touched upon, most people don't seem to get a good sense of, financial literacy and, some of these basic financial concepts. And one of them would be inflation. So stated simply, inflation is simply the general increase of prices over time. And prices of goods and services. So it's just a normal thing that prices of things will increase over time just because the unit labor cost for people to make things increases, and also generally the prices of resources to make these things increase. So the example I like to give is, the example where, if you were, a teenager, and I did this many times. I would go to the corner store and I would buy a Kit Kat. And I can remember when I was a teenager, those Kit Kats were selling for 40 cents or 45 cents. And now you go to your corner store and they're at what, $1.25, $1.50 if they're on special. The prices of things have gone up over time. Now, on average, this is just an average, inflation is about 3%. And it's usually understated. And there's a reason for that. That's because governments, our government, other world governments base social incentive programs on inflation. So it's in their best interest to say, well, inflation hasn't really increased that much. So it usually understates our increase in the cost of living. But if you look at housing costs, would be the big one, other things, vehicles or whatever, a lot of things that we consume and we need, they've increased much greater than 3% over the last 10, 20 years. So this is a very important concept because you want to be investing to protect your purchasing power. Inflation will erode your purchasing power. So $10,000 10 years ago is not the same as $10,000 now.
Even from last year, I bought myself a patio set and I really wanted it because I have kids, we entertain, and maybe not that much this year. And, I ended up getting a really good deal because the employee had sold the one I put a deposit on to somebody else. And so they had to give me the more expensive one for cheaper. But the guy was telling me that they doubled in price in the past year because the containers doubled in price.
Right.
Gas, the shipping, even here, our gas, 6 months ago, we were at $1.20 and now we're hitting $1.40.
Exactly. Exactly. So those are all great examples of inflation. So one thing that I tell my clients and a lot of people that I meet is you should never have money that's just sitting and not getting any interest. And you should try to earn interest or a return above the average inflation rate. And again, that 3% number, that's historic over time. We're seeing signs this year and signs that inflation is picking up at a much higher rate. So it's going to become more and more important to investment to invest and protect your purchasing power. Another basic that I think people need to know is the difference between investing and speculating. I think a lot of people confuse both. So investing usually implies buying something of quality that is going to protect your wealth, that will provide you with what I call some sort of normal rate of return, which basically means, over time, these are, there's some sort of return that's considered normal for whatever you invest in. So you're looking to get those returns. And it's usually something that you're doing for a long-term basis, where you're going to have a high probability of success. So chances are when you're investing, you're looking at something long-term, you're looking to be successful, you're protecting your wealth, and you're not looking to make money right away. That would be more speculation. People who speculate are looking for a very quick, short-term gain.
Okay.
You're looking for an abnormal rate of return, much higher than what is considered, customary. There's a high chance of losing your capital, and there's a low probability of success, but people are attracted to it because of that small chance of making a killing. It's almost like gambling.
Yeah.
So I think people need to know the difference, and when you're protecting your money against inflation, when you're building an investment plan, you're looking to invest and not to speculate.
Well, I think, also we need to be smart and ask questions,
Yes.
right? Ask questions to the person who's managing your portfolio. Just because some dude on YouTube or Facebook or TikTok and
Yeah.
or whatever other site there is says that they made money, doesn't mean you will, right?
Exactly, and then that's probably a negative thing, I would say, with investing nowadays. I think people don't understand the investment professionals and what they do, and the different expertise. And I give a great example to clients and prospects, and it's a simple example of a person who has heart issues. So let's say one were to have heart issues, who do you go and see? I mean, do you go and see a nurse who doesn't have the education or qualifications? They might be able to tell you, you're gonna, your blood pressure is high and you should look into it further, but they'll refer you to the doctor.
Mhm.
Then you'll have your doctor, which is usually a general practitioner that most of us have, and they'll have a general experience in medicine. But again, they're not going to be the specialist that's going to deal with all heart ailments. They're going to probably refer you to a cardiologist who knows all about the heart. So that's the analogy that I give to my clients and prospects when they're dealing with a portfolio manager. We're more like a cardiologist, the investment experts and specialists, just based on our level of knowledge and expertise. So when you're dealing with different people on YouTube saying things, you got to really be careful. Even when you're dealing with other professionals, you need to understand what their areas of expertise are and the limitations of their advice are. So when you're dealing with a financial planner, for instance, their main expertise is in building these financial plans that we've touched upon, but they won't create the portfolio like a portfolio manager does. They'll go out and use some sort of vehicle to do that, to get the returns that the clients need. Advisors too, there's advisors, it's a really general concept in Canada. And you don't require registration in order to be called an advisor, and the expertise really varies. So you have to be careful too with what kind of information they give you. So yes, to answer your question, you really have to be careful nowadays with who you listen to.
My mom worked in the bank her whole life.
Mm.
And she sold a lot of products that I don't think she really truly understood. She sold
Yes.
them to herself also.
Right.
And she was always like RRSPs, RRSPs. And then she retired
Yes.
and she needed said RRSPs. So she took the money out. And then the tax man came along and she was so shocked at how much she owed, right? Because
Right.
it's income. And it's income and it's added to your current income, and she
Yes.
has a really good pension, and so it put her in a much higher tax bracket when she needed that money for some renovations. And
Right.
people don't think of these things.
Well, again, this is the other reason why you should, again, the advantages of working with a professional that'll help guide a client with respect to tax implications. Most financial professionals have some sort of knowledge with respect to tax ramifications. And the best example that I can give you is to help a client differentiate whether or not they should use a registered or what is called an unregistered account. So the example that you're giving is the example of a registered account, which is an account that tax defers or tax shelters investments until the time where the client takes out or withdraws. So an RSP, a TSFA, tax-free savings account, registered retirement savings plan. There's all different types of registered plans as well. These are types of registered accounts. And the government, because you're getting a tax deferral, the government wants to know about them. So they're registered with the government. That's why they're called registered accounts. So a professional like myself will help the client decide, where is it more advantageous? Is it better to open up an RRSP? Is it better to start off with a TSFA? That's going to be depending on the number of assets the client has, their age, the types of returns that you get. There's different types of returns. You can get a capital gain, you can get a dividend, you can get interest. There are different tax ramifications of each. So there's reason to select certain types of investments in registered accounts.
Yeah.
And that compares versus a non-registered account, which is simply an investment account, and usually in Canadian dollars, where you do not have any tax shelter from the government, where anything that you make there will be impacted with taxes at various rates according to the types that I described: capital gains, income, interest, and dividends.
Yeah, because it's important to. It's not only how much you're paying in taxes today that matters. It's paying how much you're going to pay when you take that money out, that really matters. And I think a lot of people don't ask questions sometimes.
I also think it's not just about asking questions. I think it's about trusting the person that you work with. And here's another advantage of working with a professional, is that the more information you give them about your situation, generally speaking, the more they're able to help and see areas where it'll be beneficial for you. So in my experience, it's also been about the client talking about, all their investments that they have, where their income is coming from, if they're expecting to get some sort of inheritance. These are all really important factors in order to build, some sort of investment plan. And that leads me to another important investment basic, is that usually a professional will be able to help with some sort of tax planning or wealth management idea to maximize the client's wealth. So every year or every period, the client should be looking to calculate, what are they worth? What's the value of their financial assets plus their fixed assets, home, and if they own other assets, less any debts or mortgages, and come up with what is called a net worth value, and track that over time. That becomes the most important factor to build wealth over time.
And so, how much should we be saving?
I think you really should be saving as much as you could. Some people talk about, religiously saving about 20% of your income. It should be as much as you're able to do. And the miracles of saving and investing are well documented. I think it was Einstein who said that the eighth wonder of the world is compound growth, because over time, earning a rate of return over over consistent savings or cash flows, it amounts to a lot of money. I had a client's daughter of one of my clients recently asked me, And she asked me, she says, okay, so you work in financial field, so how do I become a millionaire? And I made the situation very real. And I've created an example on it. And it's really so simple. She's working in a part-time job where she's earning about $1,000 a month, $1,000 a month. And I just wrote down some assumptions. What if she saved $500 a month? And I can show you that example if you'd like.
Okay.
So let me share my screen. So here's the example. Oops, that's my quote screen. Here's the example.
Yeah.
So I hope you can see it right now.
Yeah, perfectly.
Awesome. So I created a very simplistic simulation, and it's a simulation that was based on what this client's daughter asked me about a month ago. And it's the example of what kind of wealth can you create with starting off with a very modest savings plan. So the assumptions are $500 a year. I've looked at scenarios where, what will the amount be after 1, 3, 5, 10, 20, 30 years? And let's take some different assumptions in terms of rate of return.
So just to be sure, it's if she puts $500 a month, correct?
That's right. So I've $500 a month, assuming my my calculations are correct. I think they are. What's the end value going to be after different time horizons at different rates of return? And let's also take an example where, in addition to contributing $500 a month, let's also take a scenario where you're starting off with $10,000 plus $500 a month. So start off with $10,000. That's the last column here. The last row here, start with $10,000. So you're going to see that the numbers are quite dramatic.
Yeah.
So let's take the first example. The first example at 3% over time after 5 years. So $500 a month saving at 3%. And after 5 years, that turns into $32,000. Look what happens after 30 years. It turns to $291,000.
Wow.
So this is the scenario where you've saved about $180,000, $500 a month for 30 years. And after 30 years, it'll become $291,000. So remember the inflation example that I gave you. I said that over time, inflation is about 3%. So this is the example where $180,000 30 years ago, you will need $291,000 to have the same purchasing power. So you must get at least inflation in order for you not to lose purchasing power after 3 years at 3%. This is why this example is a really interesting one.
Okay.
Let's take a look at a couple of other examples. Let's take some realistic examples, 7 and 8%. Look at the differences that 1% more makes over many, many years.
Wow.
Okay, this is what I discuss this with my clients, with every client that I meet. And there's a specific reason why I talk about this. At 7% after 30 years, $500 a month, a person will end up with $609,000. If I just up the return by 1% more, that amount will be $745,000 in the future. It's a huge, huge difference. And the reason why I bring this up is because dealing with a professional like myself, that's another major advantage that we offer clients, is that usually our fees are transparent, and their management fees based on the value of assets that the clients have. And they're about 1% depending on the asset size. That is very favorable in the Canadian context. So that's usually lower than what banks and mutual fund companies and insurance companies charge clients, with fees that are embedded in their products.
Yeah.
Usually in Canada, a lot of the management fees are around 2%. So you can see the example where by just cutting off fees by 1% over time, you're going to make another $136,000,
Yeah.
7 versus 8%. Let's take the 10% example. This is a really important example. On average, over time, if you invest in a diversified stock or equity portfolio, history has shown us that in Canada, the rates of return will be about 10% compounded over time. So somebody who has an above average risk tolerance that is mostly in stocks, over time can expect to make 10%. So look at the compound rate of returns at 10%. It's just huge.
Yeah.
After 30 years, 1.1 million.
Yeah. Wow.
It's just a big difference. And the last example, as I mentioned to you before, what if you started off with an additional 10,000 at the beginning? It goes to 1.3. So the way I answered my client, as you can see, was that, she should save some of her money that she's earning. She was actually considering to buy a car, a used car. And I told her, why would you do that? That's going to cut $150,000 of your future money. And I was able to prove it to her with a simple table like the ones that I'm showing you right now.
She might eventually have to save for a car, though, depending on her lifestyle.
Yes, that could be a scenario, but at the moment, it was more of a want rather than a need. Yes.
Interesting. So that's pretty.
It's very impactful. It's very powerful.
Yeah, to see the numbers, how $180,000 can turn into 1.3 million. 190,000. Sorry.
Right.
1.3 million. Now, so my question to you is, if you could go back in time.
Yes.
Right. You can go talk to that teenage self of yours or that early 20s self of yours. What would you tell them?
Well, that's a really great question. One thing comes into mind right away is I would have probably, instead of spending all my money or a lot of my savings and discretionary money when I was a kid and going to the dépanneur every day or so or whatever that was, I should have probably bought the stock in the company instead, or invested in a diversified mutual fund instead, because I would have been able to build wealth over time. That would be one. And like the example that I've given you, just to have a systematic savings plan where your money automatically goes into an investment vehicle and gets compounded right away over time. I think everybody needs that. So to answer your question, it would probably be save more and invest more.
Yeah. It's amazing because both my kids, they get their allowance, and then one of them has a job. She's 15. And so every month when they get their allowance, or when the older one gets her salary, we sit down and we say, okay, how much are we keeping in your checkings? How much are we putting in your savings? Right? Because there are birthday presents, there are Christmas presents, there are licenses these kids want to get when they turn 16. So we have to save for that. And then I say, and how much are you adding to your RESP? How much are you thinking about that? Because when you graduate, if you don't need all the money you saved, you can grab it and reinvest.
Right. Or the monies that are deposited into our RESP, they can also be transferred to the parent if the child doesn't use it. There's certain rules with that. Exactly. Yeah. I mean, again, that's a perfect example that illustrates a lot of the concepts that I've talked about today. Systematic investing in an investment vehicle. These are just parts of investment basics. And again, people need to know about this either by themselves or through an investment professional.
Yep, for sure.
There's so many different investment vehicles that nowadays you probably need to have some sort of investment professional, or you need to spend a lot of time on it.
Yeah. I know I'm sitting here going, okay, I need to triple how much I put aside because I want to have a really comfortable retirement.
Right. Well,
Countries I
then
don't travel to when I work, I want to go when I retire.
well, then it's about what kind of, do you sacrifice a little bit too on your lifestyle now for a better future lifestyle? These are some of the decisions that you have to make.
Yeah.
But again, like in the example that I've illustrated to you, with this $500 a month, I'm basically making the case that anybody can become a millionaire just with systematically investing.
Yeah.
Now, the rates of return, what you're going to end up with over time, it's going to vary. This is just a simulation. There's no guarantee that this is going to happen. You need to know the differences with different investment vehicles, and that's where an investment professional will help.
Yeah.
Usually you would want to have an investment vehicle that offers some sort of diversification. Diversification just means that you're not putting all your eggs in one basket. So you're not just buying shares in one public company, like a Costco or an Apple, but you're investing over many different types of companies. You're not concentrated in an industry. You're not concentrated in a geographic area. That's one mistake that a lot of people make in Canada, is that they have investments that are overweight in Canada just because that's where we live. And the best returns in the world, they're from the United States. So you have to have, US exposure, even though, you do have some sort of currency risk. We live in Canada. So that's another important concept, diversification. And that becomes very important when choosing an investment vehicle. I can touch on that in a very quick way if you'd like, just to give you, a really quick definition of some different investment vehicles.
Yeah, so we're running short on time, so we
Okay.
can definitely do another podcast. I mean, I'm sure people I want to know more. I'm sitting there going, I want 5 million in 20 years, 21 years. I'm not aging myself by a year yet. I want this. I need to start planning. We'll definitely do another podcast. I appreciate so much the time that you took to be here. I think, money is something that a lot of us are uncomfortable talking about, but we need to talk about it.
I agree. I see that a lot with people that I work with. And again, the more that people talk about it, the more that, especially with a professional, the more that person could help. It'll be.
Thank you so much for being here today. I really appreciate it.
You're very welcome. It's my pleasure. Nice to see you too, Miriam.
Thank you.